Paul, tell us about your background really quick.
Sure. Started out in this industry as an advisor in the early 80s with a company called EF Hutton, which is no longer here. It got bought by a company called Shearson, which got bought by a company called Smith Barney, which got bought by a company called Morgan Stanley. I went to work at all those folks, eventually transitioned into home office. And when the business was sold to Morgan Stanley, became the vice chairman for wealth at Morgan Stanley. Ultimately, really got enthralled by the idea of the independent space and what could possibly be done there. Spent a year in between Morgan Stanley and what ended up being UBS. And I worked there and was responsible for all of the products and services, which is what I've been doing for these large global banks. That said, after almost 40 years in the business, it has become clear to me, and I think it's many of your listeners would agree, that the independent space is the most dynamic space. I think it is the best space in that I view and believe that what's best for clients and advisors is done better in the independent space and better in the independent RIA space, to be more specific. Anyways, I'm started my own company, and we're looking to support and help advisors grow their business and invest in their business along the way.
Mm-hmm. Well, so it sounds like you have a lot of experience in the industry, 35, 40 years, right? Now, looking at the future, next 10 years, what does the industry look like regarding RIAs versus wirehouses?
I think it's dramatically different than it is today. There are 630,000 registered reps in the broker-dealer business. There are 60,000 reps in the RIA business. There are only about 5,000 firms total, and of those firms are about 60,000 reps. I believe that in the next 10 years, that the numbers will come close to parity. And I believe that because of the technology that is now available, and the capital that is now available, the regulatory changes and that support this. And truthfully, because independent advisors can have their own thing, they can have their cake and eat it too.
What should a wirehouse advisor be thinking about when they want to go to an RIA now?
I think there are a lot of people. I have great friends there. Obviously, I was there for 38 years, and you could say, "Hey, I've been part of the problem. Now I want to be part of the solution." But it really depends. There are some advisors who like the brand, and they like the fact that they don't have to run the business; they just have to serve their clients. And for those advisors, it's fine. The problem is that those advisors are giving up millions of dollars over the length of their career, and they don't know it. The reality is that the average advisor will have anywhere between 10 to 20% increase in cash flow. More importantly, the advisor gets to make his or her own decisions. And all you have to do is be an advisor one time in the wirehouse and go tell your branch manager that you want to hire somebody new to help you, and have the manager say, "You can't do that." And then you say, "No, but I'll pay everything." And they'll say, "No, but it doesn't matter what's happening here in Dallas. There's a freeze in New York, so you can't do it." And because of many of those kinds of restrictions where you cannot make your decision, because the large firms, which do a decent job for clients, and I really believe that the advisors that there are very talented. I just believe that being able to make a decision about what's best for you, your firm, and your clients is really important in these days. And that's why a large portion of people who are in the traditional space are going to switch. They're going to switch because the things that used to stop them, technology and capital, are plentiful and available.
So Paul, as you know, I went through this process last year. I thought it would take me 3 months. It took me 6. And that was with a staff that I'd been working with for a long, long time. when you frame kind of the value proposition to folks that are in wirehouses and have the choice, how do how do you frame that transition? How do you talk about how to make that transition go smoothly?
Well, for those of you who don't know my friend Mike Russ, who could not get into the Naval Academy, so he attended the Air Force Academy. He's a very bright guy. He's one of the smartest guys I've met from the Air Force Academy. But Mike and I are old friends, and I have to tell you, Mike is a very detailed guy and really understands an awful lot about what's going on in this business. And when he says it takes 3 to 6 months, the real answer is it takes 12 months or more. And when he says it takes 3 to 6 months, he's not telling you about the 12 to 24 months that he put in before in researching all of these things. On top of all that, in addition to all the work that you have to do, it's a fairly significant expense. There are firms like ours that are willing to take on that burden for you and build the entire platform for you and build it around kind of what you want to do, that are willing to go get capital that you may need to be able to sign leases or encourage people to come and join you. So for firms like mine are there, and I would be readily admit there are some others. We like to believe we do it the best, but that will really help you in transition. And transition is not easy because while it is a better place, though, you are going from being an advisor to being an advisor and a business owner. And I don't want to insult any of you who feel like you already own your business, but you do not. When you go independent, you do. And you make all of the decisions. That's the good news. The bad news is you make all of the decisions. And what we are trying to do is to be able to create something that's turnkey for you, that's built a custom around for you, and we'll do all of the work for you. So think of us as a concierge for you. And in addition to all that, we want to invest and become a partner with you along the way.
And as you have conversations, and you've had conversations like this for a long time, are there advisors that after that first or second conversation, you realize they're better off just staying where they are?
Oh, absolutely. Absolutely. Listen, I left UBS because I think that the large size of the businesses and the inherent conflicts that are part of that mean you really can't have the optimum solutions. But as we said, I don't know if it's 20% of the advisors that are in those things, which is about 10,000 people, by the way, or it's some number that's slightly more than that. But it's not much more than that. The average advisor that grows up in the wirehouse firm makes a lot of money, is very happy with where they are, and does not want to bring on the additional work that is there. They're willing to give up the millions of dollars because they are comfortable with what they are making. Now, for those of you who are thinking about this, you are losing 20%. That's what you're losing. And that number may, by the way, that number may be 10 and it may be 30. I don't know for sure for you, but on average, it's going to be about 20%. What's more important is one day you're going to want to sell these businesses. And when you sell those, the capital gain difference, of course, is half of what ordinary income, which is how you sell your business when you're in one of the traditional spaces. The thing that's actually more important, though, is your ability to decide when do you want to add staff? How many different programs do you want? What kind of record keeping do you want for your clients? What kind of investment solution do you want to have access to? While the economics ought to be enough for you, I would encourage you, if you don't have the interest in being able to make those kinds of decisions for yourself, it's probably not the right thing for you. But the economics are compelling, but the real reason to pursue independence is the ability to make the decision of what's the name of your firm? How do you want to market yourself? When do you want to hire somebody? Do you want to buy somebody else? Do you want to focus only on financial planning? All of those things mean you're going to do a better job for your client. And having other people make decisions for you isn't as worthwhile as you think. And while both Mike and I will draw lines and tell you, hey, none of this is easy. That's true. There is nothing good that was ever easy. Everything that's good is hard, but you can do it, and you can do it with firms like ours and with friends like Mike. Mike probably has at least 3 friends in this world, and so I'm sure they will call him when it's time. I'm kidding. Mike is one of those guys that has 8 million friends because he's such a great character and really fun person to be around.
I got a
I'm
question
really
about.
buttering you up, Mike.
He's buttering you up. Got a question about cognitive dissonance. Speaking of that, so when people are considering moving businesses, right? Maybe they think that their business is valued at a specific way or at a specific level, right? And sometimes they might be a little off, right? Maybe they think it's way more than it's worth. How do you come to evaluation?
Yeah. Well, in this space, you're right, but it's similar to the housing market. I'm in Dallas, and probably like a lot of you, the housing market, blew up last year, blew up meaning it really went high. And it's not that hot right now, and it's really hard for people because they saw somebody said like, that house sold for $2.5 million. My house is way better. I've been in their house.
Yeah.
And my house is way better than their house. Okay, I'm going to ask 3 million, and somebody comes by and says like, hey, the square foot, blah blah. I think advisors justifiably have a lot of pride in their practices that they've built. Every one of them is in fact unique. I think advisors are snowflakes. I don't think there's one that looks exactly like the other. There just isn't. They have very unique businesses, but the way that it's quite simple. The way the entire market does valuation, they do it on one of 2 things. Either they do it on revenue, or they do it on profits. When you're in the wirehouse space, you don't have a profitability statement, but we can intuit one. We can derive a profit by the number of people you make, what's your revenue. And by the way, for those of you who don't know, in the traditional space, we find that your gross production, all of what you are paid on, is about 80% of what you earn on average for the company. That is another way of saying, if you're $1 million producer, you're actually probably producing $1 million, 1.2 million when you go to the traditional space, because you start getting, there's a haircut for everything. For those of you who don't understand the P&L, there is a haircut for every product in some way, and those haircuts add up to a lot of money, particularly in the banking side. And when you go independent, many times you're able to recapture those. And so when we recapture those, we can posit an EBITDA, which typically in the independent space is somewhere, and this is a wide range, but 10 to 30% of that. If you are less than $1 billion, you're typically going to get a single-digit multiple. If you are more than $1 billion in assets, and you run a business that doesn't have a lot of people, you potentially could get over into the double digits. But if you are anything less than that, if the average advisor is about between 100 million in the traditional space, between 100 to 200 million, you should think that they will be willing to pay in the independent space about 200%. Typically, 100% of that is upfront, and 100% of that is back end. Could you get more than that? Probably not. If you're 100 to 200 million, and let's call it less than $1 million in revenue. There's another thing called EBOC, which you've probably heard, which is EBITDA, but it's earnings before owner's compensation. And in that case, you'll hear a number like 5 or 6 times kind of what you do. But before you try to do that shorthand math, sit down with someone like me who can look at your gross statement and really give you a better sense of what kind of revenue you're likely to bring over. By the way, you haven't asked me this question, Ryan, but if people want to know, the average bring over is 90%. So all of these people that are telling you and giving you these things, oh, you're going to lose a lot of your business, that's just not true. If you're the average advisor that has strong relationships with his client, you're going to find that 90% of your business transfers. Not all of your clients are, but the ones that you want, they do. And they're there. I know this comes as no surprise to you. They are there because of you, not because of UBS. As much as I love my friends at UBS, it's about the advisors at UBS, not the firm UBS. Ryan, did I answer the question?
Yeah. You got it.
Well,
right.
and you introduced the metric that I've heard as I've talked to others in your world of earnings before advisor comp, owner comp, or whatever. In many cases, what people in our Paul age range are trying to do is they're trying to find successors. I think it's a lot easier to do because you're not boxed in by what the firm wants. Talk about how someone can, I've heard 6 times EBAC or EBOC is about the right multiple. But as you think about it, what are the ways that one can push up that multiple over time? What are the ways you can make your business more valuable?
Really smart advisors who are within 10 years of leaving. First, get big, because driving more assets, more revenues through your pipeline is the first thing that you want to do. Secondly, clean it up. If you've got a bunch of clients that are, you have to really take a good hard look. Is the revenue that they give you worthy of your time? And if not, you need to focus on somebody else because they're taking time away from you and the offering that you could do with others. The third thing to do is to focus on the quality of your billing process and really take a look at what you're doing and determine, in many cases, I would tell you that I think the average advisor undercharges. I think the average advisor doesn't have as much confidence as they should. And thinking about that a few years before you retire so that you ensure that as you add accounts in the last couple of years, you're adding them, if you're doing 70, maybe the real number is 75 or 80. And I'm not suggesting that fees are not coming down. Of course they are. But I believe that the vast majority of you will be able to do that. The final thing is getting to certain numbers, getting bigger means a lot more money. The difference between the multiple that you will get for a book that is 200 million in assets is very different from the multiple that you will get. It's the same money. You're taking out the same amount, but the difference could be as much as twice as much by just moving yourself up to a little bit larger place, either through acquisition, which is the fastest way to do it, or another way to propel your organic growth. But really focus on cleaning your business and improving it to a place will matter a lot. And remember, if you're in the traditional space, you're selling these things for 200 times, and that sounds like a lot of money for their retirement programs. It's not. I can tell you as a senior executive, and I was on the operating committee of both Citi, the global operating committee for Citi. I was on the operating committee for Morgan Stanley. I was in the senior management top 60 at UBS. I'm telling you right now, they love that deal. If they love that deal, it's not a good one for you. I mean, if you don't know who there's an old saying, if you don't know who the sucker in the room is, you're the sucker. And all those people who are selling their book for that's really great, but they're literally somewhere between a quarter to a half of what they could do if they had moved on the independent side, which is another way of saying, like, don't try to move on the independent side the day before you retire. Like, give yourself 5 to 10 years, and the amount of money that you will leave for your friends, for your family, for those who are helping you extend the servicing of these great clients that you've accumulated. The difference is a very, very dramatic amount for you. And I would encourage you to think about it.
Mhm. I have another question about kind of working for a wirehouse. So when you're there, a critical metric for valuing a business sounds like it's a trailing 12, what your revenue was over the preceding 12 months. And I'm wondering, are there any other metrics that could determine what your multiple is?
Sure. Your percentage of fee-based business is the first and most important one, because the fee-based business is where, of course, first of all, where those in the independent RIA space make their living. And so and when I look at books, and we all know this, the commission business coming down. Now that doesn't mean and not only coming down, but commission in terms of stock commission. It will not be, I don't think it will be 10 years before even the traditional firms just eliminate it. It's just getting to a point where clients don't believe that it's really worth it. And the truth is it isn't. But there will still be broker-dealer business because of products like annuities, private deals. Those are still done. 75% of those are still done on the broker-dealer arrangement. Structured products are there as well. But what we do is we sit down and we take a look at your book. We take a look at what the termination factor is. Are you losing 2 to 3% of your clients' assets a year, or are you losing 5 or 10? We sometimes look at books and people are losing 10% a year. You got to we those who are going to value your business are going to take a look at that and give you a haircut on that business. They'll take a look at your regulatory record. That's why it's so important to keep that as clean as possible. Don't believe the firm if they say to you, hey, it's no big deal, we have to put this on your firm. Your U4 is super important, and you want to make sure that you fight hard that anything that's put on there accurately reflects who you are and what you are. How many people you have dictates what your profitability is going to be like. So generally, an advisor who has 1 assistant or 2 assistants is going to be more profitable and somebody we're going to be more interested in. Your growth record may be the second most important element that you can have. Somebody that's been able to show consistent growth of 5 to 10%. And for those of you who don't know, the traditional space organic growth is less than 1%. The average firm advisor opens after they have been in the firm for a decade, opens up 1 relationship a year. 1. And so if you are one of those advisors who opens up 1 every month and gets and has fairly strong retention, you're going to get a premium deal. So maybe instead of being a 5 multiple, it's a 7, and maybe instead of 200%, it's 250 or 300%, which all of you know is being offered in the traditional space to make the move. The difference there is most of that when you're getting into for those of you who don't know, when you're getting into the 300% deals and more, because there's some indication that some are getting more than that. There's a lot of caveats on that. And some people think, oh, right, Hatch, okay, this time I'm getting the good deal, right? And the answer is no. If the traditional firm pays you 350%, it's only because you have grown your business pretty dramatically in kinds of things like banking, where they are really profitable. And I will tell you that the best deals for them are the ones that people hit their marks. It's the best deals for them are not how much they paid. It's the worst deals are how much did you pay up front as opposed to back. So you always want to try to get as much up front as you can. But the real money comes in the back end, and many firms are willing to give you big numbers there because they just do the math. They know that most of it's coming to them, which is why they're happy to pay you for that. And so I hope that's helpful.
Yeah. Question about technology. Fintech is obviously very big. How is fintech helping advisors right now?
Well, I'm super strong believer in technology. I am not a one that believes that technology is going to take over the role of the advisor. I think that's just ludicrous. And the ability for advisors to understand what their clients' true needs are and to match those, to be a confidant. We all know how difficult the markets are right now, and we know what's happening with people who don't have good advisors. They're bailing out. And when are they bailing out? We're within, maybe some of you think we're going to go down another 50%. I do not. But I do believe that over the next 30 to 90 days, a lot of really good clients are not going to have good advisors. Those good advisors sit them down and say, listen, this is how we're positioned. I bought companies and good investments for you for a reason. We knew this could happen. You and I talked about it. I understand how you feel, but I'm telling you right now, this would be the worst thing that you could do. And because of that, and because you're looking them in the eye, and because you're not a computer, they don't make that change. There are countless number of studies that have done and clearly indicate that the biggest thing that an advisor does for clients is keep them focused on the investment plan that they agreed to, the financial plan and the investment plan. And just doing that allows clients to ride out these difficult dips, but participate in the rallies that invariably we know are coming. The world is not coming to an end, and neither is their portfolio. But if you don't have an advisor, you just have a little machine that says, hey, don't sell. And by the way, those machines aren't very good at picking when and when not to. You as an advisor, you're better.
So number one, I have one observation and one follow-on question, Paul. The observation is that sounds like a great endorsement for my new book, The False Hope of Global Diversification, Confessions of a Portfolio Management Maverick, which will be made available to anyone who wants it. But my question is, I think the way Ryan was spinning this was, in the world I have now, have such a wide array of different technology applications that are far less expensive than I had when I was a wirehouse. And how, as someone leaves a situation where they're just given something, now I have choices. Are there processes that you have observed to figure out what the greatest technology is as an independent, or is that solely based upon the individual?
No, it's a really good point to move it to that part of the question. And the first thing I would tell you is that the technology in the independent space is better than the technology in the traditional space. And that's been a big flip from 10 years ago. The reason for that is twofold. First, the technology is moving at a pace that it makes it very difficult for traditional firms that have 15,000 advisors and 5 million clients every time they make changes, they got to stop the processes, they got to change and everything. They also have legacy issues. So they have tech that's critical to the system that was built as much as 30 years ago. And the process, what it really looks like, I'm just going to give you a picture. It's a bowl of spaghetti that you took and you throw it against the wall. And then that's what the back of the thing looks like. And you have to go in there and take these new APIs and you have to connect them. Well, what do you connect them to? There's like 4,000 of these things. And the people who put it together 30 years ago, they're dead and they can't tell any tales. And so they can't tell you, well, by the way, if you do this, you're going to break this. And so there's an inordinate amount of testing, which is one, very expensive, and two, takes a long time. And the result of that is the technology in the traditional space, while it's integrated, while it's picked for you, so you don't have to make a decision, it's not as good. And that gap, it will continue to grow and favor the independent space, which all of the solutions on the independent space are built modularly. That is, your CRM will work with lots of different solutions. Your order management system and portfolio construction system will work with lots of different things. It also means, because it's built as an API, it gets updated because they don't have to go to the firm and say like, oh no, we have to build an HR system right this year. So we can't help you and your client because we want to make sure that you take those those automatic educational tests, and we've got to build a system that's going to cost us our budget. So the fact is that the independent space is modular, it's more up to date, and truthfully, you think you've got it scale at the traditional space. You do not. The firm has scale. You don't. Well, I would say that I think the prices in the technology are going to come down very dramatically as the independent space, which, as I've said to you, I believe it will double in the next 5 years and double again in the next 10 years. And the last thing I will say about the technology is, look, staying somewhere because you don't have to make a decision may be the worst decision. And I'm going to use an example from 1984 when I had a good friend who told me he was going to buy a contract mutual fund. For those of you who don't know this, we used to have mutual funds where you could sign up and you committed yourself to 20 years of $2,000 a year. And as a result, the advisor that recommended that to the person got 100% commission of the entire. So the entire first premium was 100%. And if you as a client then left, you would forfeit your entire amount. So instead of the commission, losing a commission of 1 or 2 or 3 or 5%, you lost 100%. So I said to him, so what I hear you say is like, you're doing that because you need somebody to enforce discipline or help make a decision for you. So I told him, like, invest with me. And if you ever call me up and tell me you want to liquidate it, I'll come over to your house and punch you in the face. Now, I think that's the same thing with technology, which is, look, the decisions are not hard, and there are people that you can consult with. And most of the ones like the aggregators, and we're an example of those, will have a team that will say, what do you need? What do you like? And they will put it together. Many of them have very good technology that's already available. It really depends on you. And if you want to go to a place where it's just one solution, you can. If you want to spend some time and you really like to do that, I would say that's ridiculous. Like, you'll end up like Mike, and you'll have done a lot of work. And Mike actually has a really good solution right now, but he had hair before that happened. Just so you know.
So
Anyway.
I want to ask kind of a final question, and then we'll go into our final four. I got the name Vestria, right? That's good. I want to, is you guys partner with a company called Vise?
Yes, we did. One of the things that we have really found interesting and fun about the independent space is what I just told. We have all this really interesting technology. And in this case, this has been built by a couple of high school kids who got hired by investment banks when they were 16 years old to go to their conferences and talk about AI. Now, they parlayed that and a lot of instructions in with advisors who hired them to help them put together a portfolio management construction and a research engine. So they put both of those together and realized, hey, we could automate the time it takes and the effort it takes to put together and construct portfolios. And then we can automate the process of not only managing it, rebalancing it, but tax loss harvesting, budgeting risk so that you only take a certain amount over a period of time, changing kind of how you transition from one portfolio to another. You can do that all by a computer. You can also shade it so I like growth, and I like small cap, and I like international. You can make all those decisions yourselves, put them into the computer, and it will do everything that you've asked it to do. So it's like having a 27-year-old kid who graduated from Harvard when he was 13 and went to the London School of Economics when he was 15. He's now 25, and he's going to do everything that you tell him to do, and you don't have to do any of it. And that's what it is. So you never have to worry. And we expect to do somewhere between 10 to 15 of these really unique kind of technological enhancements that allow, we hope, this is our goal is that everyone that is in our team and in our system will be able to manage $1 billion a year, or $1 billion as a portfolio. And we believe that it also means they can, the average advisor manages about 300. We think we can raise that number well above 1,000 for average advisors, giving really good personalized advice by using technology to help them do things. You don't get paid to write tickets. That should easily be able to do. The same is true of a lot of other things that you do. And so that's what we're doing with VIAs.
Perfect. We've got 4 final questions, and then we'll let you go.
Sure.
First one, in terms of the ideas that have guided your thinking, books, Netflix documentaries, right? Maybe media. Maybe you saw a great tweet one day. What are 3 different favorite nonfiction books or references that has guided your thinking?
Well, I'm trying to remember all the different books I have. Say that they're running my. I read about a book a month, and so I should have them right on the tip of my tongue. The guy who the investment strategist, you might know him, Mike, from Oak Tree.
Howard Marks.
Yeah, I love him. And his book, he's got a couple of books. But the most important thing is the one that I read all the time, and it's great. The guy who runs Blackstone,
Schwarzman.
Yeah, Schwarzman. Schwarzman's got a book, and it's really.
I think it's
good.
called What It Takes, right?
What It Takes.
Yeah.
And I just absolutely love that book. And then I of course classic Warren Buffett. It's hard not to get a lot from Warren. He truly is an extraordinary individual. I don't think anybody else has come close to what he's been able to do and still does. So, and there are a lot of different books about Warren. I've read about like 8 of them. Any one of them would be good. And then I'll 2 more things I would say. Jamie Dimon writes an annual letter just like Warren, and both of those 2 are super good in thinking about how to, what's important in the economy, what's happening, how to conduct a business, and how to think about markets. I think those 2 do it as well or better than anybody.
Perfect. Tools that you love. Are there any specific tools you use on a daily basis, maybe a weekly basis, that you think more people should be aware of?
Calendly.
Calendly.
Oh my God. If you don't have Calendly, I had a friend who knew I was leaving the big firm, and he told me, "You're never going to survive. You can't feed yourself. You've been in a big firm too long." Yeah, I took great offense to that, but there was some truth to it. And what you find when you leave big firms and you go to small firms, by the way, if you do it, you'll never go back to a big firm ever. But it's hard at first because people used to do stuff for you. And I was used to having people do stuff for me. And Calendly is such an elegant program. I'm sure most of you know about it, but it allows you to send your calendar to a client, and it allows you to determine not only how much time they can book, but when they can book it. So you could say, I only want them to be able to book a 30-minute call between 9 o'clock and 4 o'clock where I am open for a half an hour in the next week. Or you can say, hey, here's all my open spots for the next 3 months, and they can pick it. It then comes back and tells you, hey, they did it, and this is where it is. And you also set it up so it sends you alerts. Hey, 2 days from now, you got this call. Hey, 30 days from now, you got this call. It's just, there are a lot of things. That's the one that comes into my mind because I just use it so often.
Huh. That's so unique. That's a great idea. What is your favorite thing to do outside of work?
Well, I got to say, now that I'm doing the kind of work I am, when you work for your own company, like work, there's no work. There literally is no work because you're just so excited. you can't blame anybody else. But I would tell you, I have started to pick up golf. I'm not good at it. I'm horrible at it.
You guys would play great
but-
together.
but I love being on a golf course with anyone. And the reason I do it is I get a walk. You know, it's a good walk spoiled one of the books. But I love the walk. I love getting 4 hours to really get to know a person. I love the competitiveness of it. What I don't love is I always have thought of myself as an athlete, and I clearly am not. And golf reminds you almost 10 times around, you're not that good.
It's like when the numbers when you're used to the numbers going higher, you're like, oh wait, I got to get a lower number.
You haven't asked me this, but I'm going to tell you what's the most important trait in our business, and it's being humble. And so I want you to add that on as a fifth.
That is, I like that one. That's really good.
You know, and there's another saying, it's like, if you don't practice humility, you will be humbled soon enough, which is true. I think the best thing that one of the best things that advisors do for clients is not get too carried away and be able to understand, like, hey, you're going to be wrong sometimes. I'm going to be wrong sometimes. I'm not going to tell you that it's not going to happen. But you also have to have confidence to go past that. You first have to have humility before you can have confidence, in my mind. Otherwise, it's undeserved confidence.
That's wonderful. How can people find you?
My email is phatch, HATCH, at Vestria, VESTRIA.com. Just like Ryan and I were talking, he knows I'll say this, is like, hit me up on LinkedIn. And I accept them all the time. And as far as I'm concerned, you can't have too many LinkedIn friends. You can't have too many friends, and you can't be too independent. And that's what I'll leave you off.
That's good. Paul Hatch, thanks so much for coming on Just Build Wealth. We appreciate the time.
Thanks very much, guys.